Let's go to the Dow. The Dow's been up, the Dow's been down, the Dow's been really, really down. But here's something today that it comes from the Dow Jones and U.S. Home Construction Index. Builders' pain shows no sign of ending, and shares drop. The year-to-date, the Dow Jones Home Construction Index has fallen by more than a third. Credit Suisse, as Dan Oppenheim said, and we expect meaningful further weakness in the coming quarters based on the deterioration in demand this fall. Okay. Deterioration in demand, home prices are not going to support new loans at the level that they were before. We've already got a bailout of $700 billion, and that's not enough, is it?
It is not enough. So let's talk first about supply and demand. When there was lots of credit available, there was a demand for housing. Builders went out and built lots of homes, borrowed in order to fund that building. People got in those homes, and
a lot of whom shouldn't have ever been able to go north.
Absolutely, but the bottom line is that we all banked, meaning Wall Street and those of us that have homes, banked on the prices going up, the values.
Any entity that has a lot of cash, Puget Sound Energy is one that has publicly reported that, you know, that they, with some of their extra cash, bought some mortgage-backed securities too.
Mm-hmm. Yeah,
I mean, it's a normal thing.
It became a normal thing as the Enron loophole exploded, and this trading of these things could happen. So Puget Sound Energy is an energy company which benefited from the Enron loophole. They just went out and used it for credit default swaps. What you're going to find is, as there was an excess supply of these homes, then suddenly there wasn't the demand, and as my mortgage went up because I may have had an adjustable rate, suddenly I couldn't leave the home. I couldn't sell it, meaning, and I couldn't stay because I couldn't afford to make the payments. So, you know, homes became foreclosed on. I think what you're going to find is a lot of homeowners that are in that situation are going to now be short selling. So they're going to go to their mortgage company and they're going to say, look, you could foreclose on this and it can sit there in the line with everybody else, or I'll stay here, make no payments to you, but I'll agree to sell this property at whatever the fair market value is at the current rate. This allows people to stay in their homes. The bank gets something, and the individuals don't end up being foreclosed upon and all of the horrible things that go with that. So
why don't we use the $700 billion bailout to renegotiate those mortgages? And yes, it makes them a longer term and it makes them pay more interest, but if they're able to stay in the houses, then that stabilizes things, doesn't it?
Yeah, so John McCain has an idea of sort of recycling an idea that happened in the Depression, and that was to buy up these mortgages. You know, as I mentioned to you, my solution is pay off everybody's mortgage that makes less than $100,000 a year, because they're the ones that really got into homes that they can't afford.
Yeah.
By paying off those mortgages, what that does is free up free cash flow so they can go out and buy and consume and all of that. They no longer get the tax deduction from a mortgage interest rate. So, you know, personally, I think those are the ones that should receive the benefit of it.
Well, maybe that's something like that's what's going to happen. In the London Times just today, the report is the U.S. mulls new bailout amid rising mortgage defaults rather. As the number of people losing their homes rose, it emerged from the U.S. government that it's considering putting together a $40 billion, just a tiny little $40 billion proposal to help prevent foreclosure. Let's go to the next quote. Sheila Bair, the chairman of the FDIC, has suggested that the government turn mortgages in danger of defaulting into affordable loans to help struggling homeowners. Final quote from this article. She told Congress today loan guarantees could be used as an incentive to servicers to modify loans. By doing so, unaffordable loans could be converted into loans that are sustainable over the long term. So essentially, he's talking about taking a loan that has 15 more years left and a $1,500 a month house payment and turning it into 25 more years, and the payment goes down to $1,000 or something like that.
Yeah, I mean, I think that, you know, the question becomes, when are we into mortgage socialism, right? So my suggestion was such, I mean, we're either into Wall Street socialism or we're into mortgage socialism. I mean, the point is we have to do something to fix this problem now. In fact, Alan Greenspan, the former chairman of the FDIC, said today, oops, we got it wrong as economists. We assumed that this trickle-down that if we deregulated everything, including the banks, that would work in this trickle-down economics. And he clearly said everybody is in shock right now that thought they had it right.
All right. At the Integrity Institute, you know, Sarbanes-Oxley came into being after or as a result of Enron and other scandals. What kind of regulation do we need to be able to stop this?
Well, you know, it's interesting.
For good.
Right. So I met with Ken Lay just 2 weeks before his death. And one of the things that we talked about is really sort of how this was going to end up in a meltdown. Not because deregulation by its nature is bad, but because traders and companies that sort of ignore the controls that are necessary to make sure that it doesn't get out of hand, that when they ignore that, they create risk for everybody. Mm-hmm. And he had sadly come to the awareness towards the end of his life that that's what happened at Enron. They simply ignored the controls, or the CFO hid the controls from them or hid the risk from them. That's what we're going to end up with here, is that deregulation on its face is not bad. But if you let everything go and you have unbridled greed, the two are absolutely deadly.
Well, there's been a lot of talk about executive compensation constraints. Ken Lewis of Bank of America even agreed to them. Said it was a good thing, you know, but others are not going to. Something interesting, Fed Chairman Bernanke said today that we may seek new tactics as the Fed rate nears maybe 1%. And basically, let's go on to the next slide too. There is a real recognition everywhere that this is a crisis, and it's a scary crisis, and these people are very, very scared, aren't they?
Yeah, they're the smartest guys in the room. You know, they're the ones that were supposed to keep this all solid, and they're finding out that they got it wrong, in the words of Alan Greenspan. So if Alan Greenspan can't get it right, and we've entrusted him as the former chairman of the FDIC, you know, where are we? I think what it does speak to, Stan, and what we learned in Katrina, is that we need to take back our personal responsibility as individuals as to how much we consume and how much we borrow. The personal credit card debt in this country is out of control. We have lived way beyond our means for far too long, which is exactly what's happened at these companies.
But we're a consumer-based economy. But you're going to tell us how to get out of that in something coming in 2009. We got to go to that slide very, very quickly because we almost have to go. Due in 2009. The Global Warming of Our Global Economy by Lynn Brewer. I can hardly wait to interview you about that book. And unfortunately, Lynn, that's got to be it. Thank you very much for being with us. Go to theintegrityinstitute.com. You'll learn more. We'll see you right here next week on Public Exposure.